Hello, I am Professor Mandal from the Department of Mining Engineering, IIT Kharagpur. Today I am going to talk about modified internal rate of return. We have studied the internal rate of return or IRR, which is a key concept in the economics, or especially definitely in the mineral economics also. But there were certain problems related to IRR. So, we are going to learn something which has been modified and a better approach, which is known as modified internal rate of return. So, the concepts that will be covered are a small little review in the beginning about the IRR or the internal rate of return, and then we talk about modified internal rate of return or MIRR. Let us review first the IRR or the internal rate of return. The IRR is the discount rate, as you know, at which the net present value becomes 0. That is the concept, basic concept, that we can test the equation, which we will be again remembering now, and with different values of R, we can find out where the NPV becomes 0. So, in other words, it is the rate at which the present value of all future cash flows equals the initial investment. These are all the summation of all future cash flows, and this is the initial investment. So, the difference between the initial investment and the sum of all present values of future cash flows is 0. So, CT, where in the equation CT is the cash flow at the end of year T, R is which we are trying to find out is the IRR, N is the life of the project. So, in NPV calculation, the discount rate is known. When the discount rate is known, then you apply the NPV formula and you get the net present value of any project. But in IRR calculation, we set NPV at 0 and then solve for R, and that R, specific R, for which the NPV equals to 0 is known as IRR. This is what I learned, what we learned in the last lecture. Now, this IRR is widely used for investment evaluation, but it has some limitations that can lead to misleading conclusions. Like this is where the MIRR comes into play. So, the key issues with IRR are: number one, unrealistic reinvestment assumption. We assume that all the project cash flows are reinvestment at the internal rate of return itself, which is often impractical. So, on that basis IRR is calculated. So, it has no absolutely practical basis, but of course, there are still relevance, but there is something related to the problems of assumption of all project cash flows being reinvested at the IRR itself. Secondly, as we have seen in one of the problems, that when we solve the equation, then we may find multiple IRR. So, because of the switching between the positive and negative cash flows, this can happen in the when you try to find a solution for IRR. So, that makes the decision making difficult, unless you have one practical, one is very unrealistic, very high, 400, 500 like that. So, that we can take for assumption, but in practice, when you have multiple IRR, definitely you have the problem of taking a decision as to which value is correct. Secondly, ambiguity in the ranking of projects. When comparing mutually exclusive projects, IRR may not always select the most value adding project. This will give you two different IRRs, two different projects will give you two different IRRs, but it will not talk about the value addition to the project. So, it will give you only percentage. So, this is giving you 10%, 12% IRR, other one is giving you 17% IRR, but the IRR itself does not give you anything which is talking about the value addition to any project. But still the managers would prefer IRR over NPV, because IRR gives in a percentage value. So, you are getting something which makes it easier to interpret, but it has got some limitations, and the modified IRR is used to address all these things. Now, let us calculate, let us write down or jot down the different steps to calculate the MIRR. First thing, this is the one of the key aspects of the calculation of MIRR. First thing, to find out the present value of costs, that means cost of financing or cost of capitals. So, discount all the project cash outflows in the beginning, the investments, to the present using the cost of capital. That means, all the cash outflows will be brought back to the present values using the cost of capital, or as you know it is practically the cost of financing. Here what we can see is the present value of all cost from T0 to Tn is the life of the mine, say Ct by 1 plus r raised to the power t. So, here we are using the present value formula, we are bringing all those cash outflows to the present value. So, this is called the present value of cost or PVC. Now, for the cash inflows, that means the revenue earnings, cash inflows, we compound all expected these cash inflows to the end of the project. That means, say if it is here, so all these cash outflows generated is taken to the end of the year, and then we sum them. So, it gives you the terminal value of the cash inflows, So, now this can be expressed as TV terminal value equals to 0 to n summation 1 plus r raised to the power n minus t. N is the life of the project, life of the mine, t is at the year where we are speaking now, at the moment, at any point of the calculation. Now, so we got one is the present value of all costs, and the other is the terminal value of all cash inflows. So, now what we do that all the terminal value is again brought to the present value with using the hypothetical MIRR as the rate of return. All the terminal values, the total terminal value is brought to the present value using an imaginary MIRR, which we will find out now. So, what happens in this case, the present value of the all costs is equating the present value of the terminal value of all cash inflows. So, this is the concept. So, see the PVC, this one is the present value of all costs, and again in the equation you see the TV is the terminal value of all cash inflows, and now we are transforming this in the present value over a period of n years, and at the rate of return, which is now known as modified internal rate of return. This is not IRR. So, when you get the value of MIRR, the acceptance, that means when you reject, when you accept, when you cannot take a proper decision, the rules are same as IRR. What are the advantages over of MIRR over the internal rate of return? First thing, it uses a realistic reinvestment rate, avoiding the overestimation of the returns, where we say that they are reinvested at IRR, which is not always true. It also considers the time value of money more effectively. While both, so as we are saying here, that while both IRR and then MIRR account for the time value of money, MIRR is doing it in a structured way by separately handling cash outflows, first thing, which we do by discounting at the financing rate, that means cost of financing, cost of capital rate, and the cash flows, cash inflows are dealt with using the compounding at the reinvestment rate. So, we are dealing it separately. We are giving equal an importance of time value of money while calculating the PBC and the terminal value both. So, this is more consistent with NPV decisions. So, since MIRR assumes reinvestment at the firm's cost of capital rather than the project's IRR, so it aligns better with the net present value ranking and leading to more financially sound investment decisions. So, it is since aligning more with the NPV. So, it is in a way it is a better tool for taking decisions as to whether to accept or reject, on what basis you are taking this decision. Now, the evaluation of MIRR, just to understand the MIRR over IRR. So, there are at least two keys, 2 points, 2 important points to remember. One is the, as I said, realistic reinvestment of assumption. IRR assumes cash flows or reinvestment at the project's IRR, which may be too optimistic, as I said. Again, MIRR assumes the reinvestment at the cost of capital, which is more practical and reflects the true profitability of the project. So, MIRR is more practical compared to IRR. It avoids multiple IRRs, you get a single value. So, MIRR eliminates this issue and you get a single clear rate of return, that is all. For MIRR and NPV for decision making, if the projects are of the same size, NPV and MIRR give the same decision. But if the projects differ in size, conflicts can arise and it is better to go by the NPV, that means the value addition, instead of going by simple return. Value addition is a better method here. We will take examples one or two and try to understand how to apply the concept of MIRR. Now, this ABC Venture Limited is trying to evaluate a project that has the following cash flow stream associated with it. We are not using any crores or lakhs here, just the conceptual thing. Year 0, we have a cash outflow minus 120. Then year wise 1, 2, 3, 4 and 5 year, 6th year is the life, and the cost of capital for AVL is about 15%. We have to find out the MIRR, modified internal rate of return. So, present value of the cost is given by PBC, as we have seen in the beginning, and here we are trying to find out the value of PBC. So, the 120 is in the first year, there is a cash outflow, in the second year also we have cash outflow. So, these two we are bringing to the present value. At 15%, which is not the discounting rate truly, it is the cost of financing or cost of capital. So, this is more realistic. So, here we are bringing this 120 and 80 to the present value of cost, and we are getting the PBC as 189.6 here. In the next step, we talk about the terminal value. The terminal value of the cash inflow is given by this equation. Terminal value equals to P or 0 to n 1 plus r raised to the power n minus t. So, here we have to think about all the cash inflows that we have 20, 60, 80, 100 and 120. This we have to take it to the end stage, that means the terminal value. So, as you can see that we are gradually reducing from here 6 minus 2, 6 minus 3, 6 minus 4, 6 minus 5 and 6 minus 3, this is the last one. So, this is how we are taking this all this cash inflows to the terminal value, end of the life of the project. We are simplifying all these calculations just by the calculation is shown here, and the terminal value is 467. So, what we have to do now, this terminal value has to be transformed or rather converted to the present value using or imagining the MIRR. So, what is that rate of return? That rate of return which makes this PVC and the terminal value equal, provided that the terminal value is converted to the present value using this MIRR. So, now we replace this 189.6 for PVC and 467 for the terminal value divided by 1 plus MIRR raised to the power 6 is the life of the project. Now, solving this, we get that now just by slightly manipulating 1 plus MIRR raised to the power 6 is this, and from there we get 1 plus MIRR. The modified internal rate of return is 1.162. So, minus 1 is 0.162, or in terms of percentage we get that MIRR equal to 16.2%. This MIRR of 16.2% indicates that the project is financially viable, because the cost of capital or the cost of financing was 15%. Our MIRR is greater than cost of capital. So, we can accept the project as financially viable based on the MIRR. Let us take one more example. Here we have a mining project conceptual with the following say cash flows with mine closure cost at the end of its life. Figures are not absolute, this is only to explain. Now, in the initial year we have say 40,000 as cash outflow, and in between we have the cash inflows 10,000, 12,000, 14, 16 and 18, and then it becomes 30,000 cash outflow for the closure cost. This is only conceptual, again I am telling, do not take these values as absolute values, no way. We are finding out the MIRR for this mining project. For example, if we find IRR, we will get two values. If you do it yourself, you will find two values which is not easy to choose from. So, we try for say MIRR, a better indicator. What are the present values of the cost? The PVC is CT by 1 plus R raised to the power T. We have 40,000 cash outflow, and at the end we have 30,000 cash outflow. So, we transform that to the, bring it to the present value, and we get 56,934 as the present value of all costs, Now, what is the terminal value? The terminal value is given by this summation T 0 to n over the entire period of life 1 plus R raised to the power n minus t. Now, for the first year we use 6 minus 1, then here for second year 6 minus 2, like that at the end we use 6 minus 5. So, here we get the terminal value, total terminal value just by calculation we get 91,454. This is the terminal value. Now, what we do? We take this terminal value and we assume at there is something MIRR. So, the PVC will be equal to the terminal value divided by 1 plus, say we take a big R as the MIRR raised to the power n. So, this the typical the formula where we see the present value of all future costs. So, the future cash inflows are here the terminal value of all cash inflows is now converted to the present value over the period of n years. That means, we are being equating with the present value costs. If you do that, then and replace this value by say PBC with 56,934 and here 91,454 and solve this, you get the internal rate of return as 0.082, which is nothing but 8.2%. Remember that the cost of capital, as we have seen before, the cost of capital as we have seen here is this the discount rate is here is 10%. So, but our calculation shows that the internal rate of return, modified internal rate of return is 8.2%. So, the MIRR, let us denote is as R, which is 8.2%, and the cost of capital was actually 10%. So, the MIR is less than the cost of capital, which is in the beginning we have written as 10%. So, what we do, we take a decision the project is not attractive to the investors. Net present value is positive, but MIRR is less than the cost of capital. So, we take a decision on MIRR here. There is no confusion in this aspect. We try to summarize what we learned, that MIRR is based on a series of cash flows over time. It considers the difference between the interest rate paid on financing and the return on reinvested income. Here, the difference between the interest rate paid on financing means the cost of capital or cost of financing, and the return on the reinvested income is again transformed to the last terminal value using that return rate, and again we brought back all the terminal value together to the present value and then we equate. MIRR assumes that the positive cash flows are reinvested at the cost of capital, and it also assumes that the cash outlays are funded at the current financing cost, which is more practical compared to IRR. So, we take MIRR as more practical. IRR is definitely widely used, but this has got better practical aspects in application. Often we are also get confused as to which method is to be used regarding using NPV, using MIRR. The same problem also was there with IRR also. Here also you have the same dilemma, like you can use the MIRR when comparing multiple projects with different cash flow patterns and investment scale. So, you get only percentage return MIRR. In that case, it is easy to compare between different projects. So, this is giving in percentage, it is giving you more. So, that way you can take a decision. But if you want to see, if you want to maximize the firm value in absolute terms, that means how much value is added, then not only the MIRR has to be more than the cost of financing, maybe marginally, but we will see that the NPV is showing the addition of the value to the firm. So, we will see that where the maximize we can maximize the firm value. So, we should look at the NPV, and what we say ultimately that the best approach that for taking a complete financial get a complete financial picture and take a more realistic, most dependable solution or decision is it's better that you look at both the NPV and MIRR. If the two projects again have the same NPV but different MIRRs, the project with a higher MIRR is more efficient in capital utilization. But if a project has a high MIRR but a low NPV, it might not contribute much to the value, as I have explained earlier also. So, we can summarize in a tabular form the differences between MIRR and the NPV, like criteria is definition unit of measure, all these things. So, here we see MIRR and this side NPV. So, MIRR calculates a single rate of return considering the reinvestment at the cost of capital. This we are seeing right from the beginning, which is different from rather totally different from the concept of IRR. NPV measures the total value of the project added by the discounting future cash flows, and the unit of measure in MIRR is just like percentage like IRR, whereas this gives you a monetary value, dollar or rupees. So, what is the reinvestment assumption here? That MIRR gives you the cash flows. It assumes that the cash flows are all reinvested at the cost of capital, but here it assumes reinvested at the discount rate. These two are different in NPV and MIRR. In the decision criteria, we accept if the MIRR is greater than the required return, as we have seen through the examples. Here also we accept if NPV is greater than 0, that is positive value. Why do we utilize? Why do we prefer? MIRR is preferred when we try to rank projects, different projects based on the profitability, percentage return. Here we are more interested in the value addition. So, we evaluate the absolute project value, how much it is adding to the firm value, NPV, not exactly what percentage, but the total amount that is being added. The complexity, it is more complex than NPV due to additional calculations of different discounting rate, cost of financing, and again rate of return. These things are little complex, but more practical. This is relatively simple to compute as compared to MIRR, as we have seen. So, these are the basic differences or rather similarities between MIRR and NPV. We can conclude that in case of confusion, dilemmas, you can look at both the metrics like the MIRR and NPV both when there is a confusion as to which one is to be believed. Unless it is a very critical one, we can go by in specific case when you need the percentage, you go by MIRR, when you need by value addition, then you go by your NPV. So, in both the cases, we see that both can give you the decision making strength. That means, you calculate all these things and try to find out what is the modified internal rate of return. Also, you can see the NPV. So, depending on the criticality, you can choose either or both at the same time. Thank you very much.